Hey there, welcome to the IADS Retail Park. I'm your host, Maya Sanko. Today's episode is different from our usual format. We're not covering one market or one trend. We're covering the IADS Global Department Store Monitor for fiscal year 2024 to 2025. 58 department stores across every major region, one full year of results. Back with us again is Anshita Ranka, our head of analysis and perspectives, and the author of this year's monitor. Anshita, welcome back.
Thanks, Maya. Glad to be here, though I'll warn you. This one resists clean summaries. It was a complicated year.
Let's start with the word you lead with, vibesession. It's not a term you'll find in official economic data.
It describes a real gap, though. In fiscal year 2024 to 2025, the macroeconomic picture looked broadly okay by most conventional indicators. Inflation was coming down, growth was holding in major markets, the global economy performed better than expected. But consumers weren't spending like that was the case. Confidence was persistently negative. People were price sensitive, value driven, avoiding non essentials, and heavily responsive to promotions. The data and the behavior were pointing in different directions. That disconnect is the vibesession, and it shaped almost every result in the monitor.
And Anshita, it creates a specific operational trap. If you plan against the macroeconomic indicators rather than actual consumer behavior, your inventory assumptions, your promotional calendar, your expansion timelines, all of it is wrong.
That's exactly where several retailers got caught. And no case illustrates it more starkly than what happened in the US luxury market. Take the example of Saks. Saks Global acquired Neiman Marcus Group in January 2025 for 2.7 billion US dollars, consolidating Neiman Marcus, Bergdorf Goodman, Saks Fifth Avenue, and Saks Off Fifth into one operation. The thesis was luxury consolidation at scale. But within a year, Saks Global filed for Chapter 11 bankruptcy and shuttered multiple locations.
The timing is brutal. They made a multi-billion-dollar bet on luxury at the precise moment luxury was contracting.
The personal luxury goods market fell 2% globally in 2024. That's across fashion, accessories, watches, cars, beauty, a broad decline, not a category specific correction. The structural driver was a pullback in aspirational luxury spending, particularly among Gen Z consumers, and a significant slump in Chinese consumption driven by the property crisis and high youth unemployment. Saks built its thesis on conditions that had already started reversing.
And the damage extended beyond Saks itself. Unsecured creditors included Chanel and Kering, which is a trust problem for the entire department store model as a luxury channel.
It creates a power vacuum, Maya, and both Nordstrom and Macy's are now trying to fill it, though neither is in straightforward territory. Macy's Group dropped 3.5% in sales. Kohl's dropped 7.1%. The US market broadly struggled. Cautious consumers, high interest rates, a post election confidence spike in November 2024 that didn't sustain. Nordstrom was the relative bright spot at plus 2.4%, partly driven by Liverpool's acquisition of the company in December 2024, which brought investment and operational confidence.
And Liverpool is a Mexican retailer, a Latin American group stabilizing a US department store. That tells you something about where the momentum in this report actually is.
Latin America was one of the strongest performing regions in the monitor. Falabella up 10.2%, Liverpool up 9.6%, Ripley up 8.3%. This is in a context of currency appreciation in the Chilean and Mexican pesos, which theoretically makes things harder, not easier. What these companies had was genuine domestic consumer confidence, strategic multi-channel execution, and in Falabella's case, meaningful geographic diversification across Chile, Peru, and Colombia. The consumer confidence that was absent in the US was present in Latin America, and these retailers were positioned to capture it.
The same pattern, but running through tourism rather than domestic confidence, shows up in Southern Europe.
The weak euro functioned as a discount for high spending non EU visitors, and Southern Europe caught the full benefit. Why don't we go over the numbers a bit, Maya? So, Spain saw 25% rise in inbound spending, Greece 25%, Italy 20%. El Corte Inglés in Spain up 2.3%, Attica in Greece up 8.8%, with non-EU spending specifically rising 9% in the first half of the year. Renascente in Italy up 4.3%, with Central Retail Corporation divesting it back into a European operating structure.
Currency as the underlying story. Which brings us to Japan, where that same logic produced a year that went from record-breaking to sharply reversed within the same fiscal year.
Japan is the most instructive case in the monitor. The weak yen drove an extraordinary performance in the first half of the period. Japanese department stores reached 5.75 trillion yen in sales in 2024, topping pre-pandemic levels. Duty-free sales set a record for the second consecutive year. J-Front retailing up 10.1%, Takashimaya up 6.9%, Isetan Mitsukoshi up 6.5%, Marui up 8.2%. Then the yen appreciated. By mid-2025, tax-free sales had fallen 40% year on year. Average tourist spend dropped. Department store sales fell 7.3%. A record year followed almost immediately by a sharp contraction.
And what the record numbers were masking is that the growth was never uniformly distributed. Several prefectures lost their last department store during what was being reported as the best year the sector had seen.
The urban-rural divide was hidden by the headline figures. Growth concentrated in flagship locations in tourist-heavy cities, while regional stores were declining throughout. Takashimaya's results, for instance, were explicitly driven by flagship performance in high tourism areas. The sector built a dependence on inbound luxury spending that left it exposed the moment the yen shifted.
South Korea sits adjacent to that story in an interesting way, because it was absorbing some of what Japan was losing, while dealing with its own version of the vibe session domestically.
South Korea was the single biggest inbound tourist market for Japan. As Japan became crowded and expensive in early 2025, some of that spending redirected to Seoul. So, Korean retailers got a currency-driven tourism benefit while simultaneously dealing with a strained domestic middle class. The domestic response was classic lipstick effect, consumers pulling back on fashion and big-ticket spending while maintaining or increasing spend on affordable luxury. South Korean luxury beauty sales surged 24%, while fashion growth slowed considerably. Department stores revamped their beauty counters, and that's largely what kept performance numbers from falling further.
The China picture is different in character. It's not a currency-driven story that could theoretically reverse. It's structural.
The property crisis, high youth unemployment, and depressed domestic consumption created a sustained contraction across most of the Chinese department stores in the monitor. Parks and Retail Group down 13.6%, Maui down 13.2%, Wang Fujing down 7%, Rainbow closing its Shenzhen location. The reset is deep and the conditions driving it aren't short-term. The one counter-signal worth noting is Wushang, where online orders surged 77%, and the number of online users rose 25% despite overall sales falling. The demand is being redirected rather than destroyed, but it's not coming back to the physical store in the same form.
And Hong Kong compounds the picture with a different mechanism, spending leaving to Shenzhen rather than to online channels.
Currency depreciation in Shenzhen makes shopping meaningfully cheaper for Hong Kong locals and mainland Chinese consumers alike. Wingon dropped 10.4%. Retail sales in Hong Kong fell consistently for over a year. The Shenzhen dynamic isn't new, but it's deepened, and Hong Kong hasn't found a structural counter to it yet.
And Cheetah across all of this, the US, Japan, China. The mixed pictures in Europe. Re-commerce is the one category that grew consistently everywhere.
It aligns both value-driven and sustainability-motivated consumers, and there are more of both in this environment. Vinted became the top clothing retailer in France. Galeries Lafayette opened a second-hand watch and jewelry space. Zara expanded its second-hand clothing service to the US. Japan's second-hand luxury sector boomed even as the yen rebounded. International demand for high-quality vintage pieces held, driven by social media positioning Japan as a destination for thrift shoppers. Re-commerce isn't a niche or an experiment anymore. Retailers across every price bracket are treating it as a permanent operational layer.
The AI story in this report is the one I found most interesting in terms of what's changed. It's moved from consumer-facing pilots to back-end efficiency as the priority.
The hype phase is over, Maya. Retailers shifted from experimenting with generative AI shopping assistants. Walmart and Amazon both launched versions to deploying AI internally to protect margins. But the most significant shift is in how consumers search. Keyword based searches are giving way to conversational questions through large language models. That changes e commerce traffic models fundamentally, and the retailers that haven't adapted their digital storefronts for machine readability are already losing visibility in AI generated discovery results. The report calls it generative engine optimization, GEO replacing traditional SEO. It's not a future development, it's happening now.
The 2025 to 2026 outlook in the report suggests the instability from this year doesn't resolve, it compounds.
Trump's second-year tariffs are actively restructuring supply chains with more volatility than the first round introduced. The Middle East conflict following direct military engagement between Israel, the US, and Iran has added logistics pressure. In Japan, a Chinese tourist boycott is driving a sharp downturn that's exposing the sector's dependence on inbound luxury spending all over again. South Korean stores are reporting record foreign sales as the redirect beneficiary. And the gallery's Lafayette flagship opening in Mumbai in November 2025 signals how seriously India is now being treated as a luxury market in its own right. The patterns from this year's monitor, currency dependency as vulnerability, re-commerce and experiential retail as durable, AI as back-end infrastructure rather than marketing, those hold into next year. The conditions testing them are more severe.
Quality over quantity on the physical retail side. The data supports it.
Retailers closing underperforming locations to fund flagship investments. The monitor shows it consistently. Whether the economics of that hold through another volatile year is what the next edition will answer.
All right, folks, that's all we have time for today. The full report is in the episode description. There's a lot of regional detail we didn't get to, including the UK's tax-free shopping disadvantage, Scandinavia's structural headwinds, and Australia's consolidation story. Worth reading alongside this. Thanks for joining me on the Retail Park in Cheetah.
Thank you, Maya. We did get to cover a lot in this episode, but definitely check out my exclusive for more. See you next time.
Thanks for listening to IADS Retail Park. Find us on LinkedIn at the International Association of Department Stores on Substack, and visit our website for more insights. Please be advised that this podcast features AI cloned voices created with human oversight.